Guys, for the last few years, short-term interest rates were almost zero, and so they didn't matter. That has changed now, and so where you put your cash that's in your brokerage accounts could actually add up to some really big money. So in this video, I'm going to go through my Fidelity account, and I'm going to look at the options for where you can park your short-term money. So I'm going to look at the Fidelity options for bank CDs, money market funds, and the Treasury bills. And specifically, I'm going to go ahead and buy Treasury bills at an auction and Treasury bills in the secondary market. And then I'm going to compare all the rates between the Treasury bills, the bank CDs, and the money market funds. So let's get started. Okay, so from the Fidelity account, go to Accounts and Trade and just hover over Trade. And then this window opens up. Go to Fixed Income Bonds and CDs. And you'll get this first window here that says yields, but it also has bonds, new issues, CDs, ladders, annuities, and all that. All right, so you can get an overview of what kind of rates you're getting for the different kinds of investments here. So looking at the US Treasuries, this is what they're talking about when they say an inverted yield curve. The 3-month Treasuries are paying 4.41%. These are the least risky. And the more riskier stuff, when you go out to 5-year and 10-year, is paying almost a full percentage point lower. And it's much riskier to lend out at 10 years, even if it's to the government or whoever, than it is to lend out for 3 months. So there's no point, unless you think this is the top of the interest rates, that you would lend out for 10 years instead of just keep lending out for 3 months as rates go higher and higher until you think they stopped going higher. And then you might lock in longer term rates if you think they have peaked. So anyway, let's just look at what you can get. US Treasuries, 3 months, 4.4, corporate AAA, 4, AA, 3.9, corporate AA, 4.8, and CDs, 3-month CDs, 4.3%. So that is not bad at all compared to buying Treasuries. The only difference in the CDs is that you are locked in, whereas if you buy the Treasuries and you want to sell it before the 3 months is up, you can sell it in the marketplace. And so the most liquid thing you can do is have a money market account because you can sell that anytime. So money markets first, then the Treasuries because you can still sell them. The CDs you're locked into, but if you're doing it for like 3 months, you would put money that you know you're not going to need in 3 months. Treasury, you probably put it in money that you're pretty sure you're not going to need, but if you do, you could still sell it. The money market accounts, you would put those in because you're expecting that you can change your mind any day and want to sell it and get into something else. So let's just compare the money market rates to the CDs and the Treasury bills. So Fidelity has this money market portfolio class 1 FMPXX, and the 7-day yield is 3.93. Not bad compared to 4.3 for the CDs. However, it has an expense ratio of 0.21, so that brings your return down to 3.7, let's say. And the minimum to invest is $1 million. So this is the premium product, and they give you a better rate. Let's look at the next premium product down. So this is FZDXX, Money Market Fund Premium Class, and this has a yield of 3.82. with an expense ratio of 0.36. So what's that? 3.46%. That's very bad compared to the CD. And you still need $100,000 minimum to invest in this. The next one is FZFXX, Treasury Money Market Fund. And this one, the yield is over here, 3.39%. But expense ratio is 0.42%. So basically you're getting about 3% on your money, and the minimum to invest on this one is any amount over zero. So basically, if you have less than $100,000 to invest and you put it in these money markets, you're going to get about 3%, which is a big difference than the CDs or the Treasury bills. Okay, so back to this screen, let's take a look at the CDs you can get. Click on that number, 4.3%. So you see these are what's called brokered CDs. You don't have to have an account with these banks. Fidelity does that for you. So North Point Bank, 4.3%, maturity date March 14th. So Most of these banks are probably very small banks that you haven't heard about, but they are all FDIC insured, so your money is protected up to $250,000. So let's see. Click buy, right? Select your account up top on the pull down menu. Quantity, one bond or one amount equals $1,000 face. So price is 100. So if you put one, you're really putting $1,000 worth of CD. And it's good, it's really good that this thing pops up so you know what you're doing, because other brokerages don't have that. And you can put in thinking that you want to buy $1,000 worth of a CD, and you're really putting in $1 million. Okay. And they have automatic rollover, meaning at the end of 3 months, they'll put you in another 3 month in the same bank with the same amount. You can choose yes or no. So these brokered CDs are really good options, and they're competitive to the Treasury bills without having to worry about Treasury auctions starting on what date or buying it in the secondary market. So definitely a good option, and it's very simple. And the yield is very similar to Treasury bills and FDIC protected. So let's go and buy Treasury bills now. Now, all of this is the secondary market. This is not an auction. All of this stuff has already been issued, kind of like an IPO in the stock market. Before the IPO, you buy it at a certain price, but after the IPO, it trades in the secondary market with buyers and sellers setting the price, and that's what all of this is. So if you want to buy a new Treasury at auction, you click up here, New Issues, and click on Treasury, and you see there's 5 of them here. Now, there are Treasury bills, Treasury notes, and Treasury bonds. The bills are from 4 weeks to 1 year, and they are sold at a discount to face value. So you buy them cheaper than the face value, and you receive face value when they mature. That's your interest. The Treasury notes come in denominations of 2, 3, 5, 7, and 10 years, and interest is paid every 6 months. The Treasury bond comes in 20 and 30 years, and interest is also paid every 6 months. I'm just going to call everything a bond just so you don't get confused. So it's like saying, I will give you a $100 bill on March 16th, 2023, how much will you give me for it right now? And that amount you pay is going to yield you about 4.165% on an annual basis. So being that March is 90 days out, you're going to get 1/4 of this approximately. And now, since this is an auction, they don't know this number for sure. It's going to be somewhere around this. They're taking this number from probably the last most recent auction, the interest rate that it auctioned off for. So this auction closes on December 12th, 2022. I believe you can put an order up until 8:30 of the morning of the auction to get in on this auction. So let's do that. Put your account in, make sure you have enough money. I'm going to put just $5,000. So quantity 5, automatic rollover, no. Expected yield 4.165%. And let's preview the order. The QSIP is just the serial number of that particular bond. Stocks also have QSIP numbers also. So quantity 5, meaning $5,000 worth. This is the approximate yield I'm going to get. And the trade date is 12/12. Settlement date 12/15. Auto roll no. Okay, let's place this order. Okay, order received. Now let's go buy a Treasury bill in the secondary market. So back to this screen again. So let's click on the 4.41%, the 3-month US Treasury. So you can sort by maturity date, see the closest one. So the closest one matures on February 23rd, and it has a yield to maturity of 4.078%. And notice that the yield to worst is the same as the yield to maturity. The yield to worst just means the yield you would get if the bond is callable. And if it got called, what would your yield be? So what that means is when a company issues a bond, let's say a 10-year bond, it might be callable after 5 years. In other words, they issue a bond today and interest rates are 7%, let's say. And in 5 years, they're now 5%. So they say, look, let's buy back that 7% bond and issue new ones at 5%. Well, if you bought that 7% bond hoping to hold it for 10 years, and now they want to buy it back from you, and for you to invest again, you're only going to get 5%, that's a problem, right? So there are things to consider when your bond is callable. And so they tell you here that if it is callable, this is the worst yield you'll get if it gets called back on the first callable date that it's available to be called. But with these Treasury bills, since there's zero coupon, there's no coupon, it's not called, it's short term, and that's why the yield to worst is the same as the yield to maturity. One other thing to notice here is that you see Treasury bills, but here's a Treasury note, another Treasury note. I thought we're buying Treasury bills, right? Well, here's the thing. These notes act like Treasury bills if they only have a few months left in them, right? This one matures on February 28th. Let's take a look at it. So the issue date on this is February 28th, 2018. So this is a 5-year note that just happens to be maturing in February of 2023. And so you can buy it right now and it will act like a approximately 3-month treasury. And so even though it says this coupon is 2.625%, that was back in 2018. It still pays out this rate, but because the treasury bill rate is over 4%, this bond is going to be priced in such a way that it is similar to a bill's interest rate that you get. So you see here the yield to maturity is 4.149%, not 2.62, even though that's the actual coupon that it pays out. But this bond is priced in such a way that if you buy it, you will get that 2.62% yearly payout. However, that will equate to a 4.149% yield to maturity for that period that you hold it. And of course, it is an annual yield, you're not going to get 4.149% holding it for 3 months. You're going to get about a fourth of that. So let's sort what's the best yield to maturity we can get here. So this one matures April and it got a 4.4% yield to maturity. Let's take a look at this one. This one was issued 12/6/2022, just a few days ago, which is kind of interesting because the brand new auction that I just bought has an estimated yield of 4.1 something. So there has been a lot of interest in short-term treasuries right now. I guess because of maybe the year end, people just want to hold cash until the year end, but there's a lot of interest. So a lot of people bidding means the price goes up and the yield goes down. But this one that was just issued, 3 days ago, is paying 4.42% until maturity. So let's buy that. Click on buy. Okay, I'm going to buy 5 of these also. Okay, so this is the ask price that I'm going to pay. So like I said, I'm getting a $100 bill from this in April, but right now, today, I'm paying $98.65 for that $100 bill. So that $1.35 that you're getting the discount is your interest. And so the yield I'm going to get by buying at this price is this yield. This third-party price is like a computer modeled fair value price for this thing, because a lot of times bonds don't trade that often. And so you want to know if you're getting a kind of decent price. So this is very close to this modeled price. Okay, so I'm buying 5, which means 5 times 1,000 each, so $5,000. And you can limit the order type by limit price or limit yield. In this case, it's not available on this. I don't know why, but okay. And time and force, day or fill or kill. Also, the day is not available to use. Fill or kill just means that you cannot fill my order partially. So if I put an order for 5, the person that's selling it to me can't say, well, I'm only going to sell you 2 at this price. I'm saying, look, here's my order for 5. You either buy all 5 at this price or cancel my order. So they have a decision to make. They can either buy all 5 at my price, or they know it's going to get canceled and I may go elsewhere. So preview order. So this is good. They show you the exact amount of money that you're putting out. Effective yield 4.41. Fill or kill. Price with markup. So zero markup. Now, even though I'm buying $5,000 worth of bonds, I'm only paying $49.32. And so that $67 or so difference is my interest. And if you want to see if this number makes sense, it is December 9th. So this bill will mature, I think it was April 1st. That's approximately 110 days. So if you take 365 days in a year, divided by 110 days, you get 3.3 of these 110-day periods, let's say, right? So in a year, I should get 3.3 times the interest that I'm getting here, $67.35, right? So multiply 3.31 times 67.35, and that comes out to $223. So on a yearly basis, I should get this amount that I'm paying times this interest rate. So 49.32 times 0.0441, and that comes out to $217. And the discrepancy between the $6 is the days are not exact and whatever, but you see that it comes very close. And so if I was a little more exact, it should come out exactly correct. So let me place this order. So if you go to activity and orders, you'll see that Treasury bill that I bought in the secondary market was filled at that price, 98.65. But my Treasury bill that I put for the auction on December 12th obviously is not filled because it doesn't happen until the 12th, but my order is there and it's good till canceled and it's still open. So after the 12th, I will also have that Treasury bill as well. So guys, that's how you buy Treasury bills at auction and in the secondary market on Fidelity. And don't forget to compare it to the CDs that Fidelity offers through those other banks and their money market accounts as well. Depending on what your time frame is for when you need the money, one of those might be a better option than the other. But if you're sure you're going to have the money locked up for a period of time, I would just go for the one that pays the higher interest rate. As always, this is not financial advice. Make your own decisions because it is your money. I hope you like this one, guys. I'll see you in the next one.